Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. I've been talked a little bit about the markets and the volatility that we're seeing, and just getting most recent news. I think the Dow's down about 300 to start the day. This was my expectation, by the way, as I said, and strong jobs numbers. So watching these numbers is a big part of this. Strong jobs number means this, the Fed is looking for the job market to weaken as a part before they ease up too much, because of the effect that the labor market can have on inflation as well. All of these things are what we're watching. So even though you get these, you had October, November were really good months, and we have a December, starting out, we're looking at weakness again here with December, and then we're going to be watching these numbers. Wouldn't be surprised if the big jumps that we had here a couple of days ago after Chairman Powell's comments and remarks, wouldn't be surprised to see that retrace and go back down again. As I said, I'm not sure if we've hit the bottom. Personally, I think we have not. I think we're going to see, unfortunately, I'm not sure that the numbers are going to be that good for November. I would love it if they were. Love to see, inflation coming back down and the Fed being able to ease up. That would be great news. And that October maybe was October 12th was our low point for the market. We'll see. But right now, like I said, I'm being cautious. And basically week after this one, we'll get a much better idea in terms of the direction going forward into next year, whether we're going to hit that bottom, whether we've already done it, whether we're going to hit it before the year's out, or maybe it even carry on into the first and second quarter of next year. So let's be watching closely. All right now, and again, but it's a great time. Not just necessarily sit idly by, but to look and see if there's anything you need to do with regard to your asset allocation. And as I said, maybe adding index annuities in might be a good fit for you. With fixed index annuities, here's where your principal is protected still, okay? So in a down market, you're not going to take. Market drops 20%, you're staying where you're at, right? You're not losing any money, but you might. So think about it. If you have a year where the market's a minus 20% as an example, getting a zero that year would be really good, okay, rather than a negative. So this is where these can play in. And again, in particular, when we talk about bonds, when you look at the bond market, and this is one of the things for the first time in 50 years, right? For 49 out of 50 years, we've had positive with the AGG, the aggregate bond index, compared to cash. And this first time this year, we're seeing the bond market be down as badly as it is, again, over 15% year to date. And when it comes to that, we want to be thinking, well, what other things could I do? And that's where the index annuities can come into play. Right? This is a way for me to get basically more protection in a down market than what I'm going to get. And when you're looking, by the way, again at that AGG, it's still down about 14, so almost 15% year to date. When we're looking at that and we're thinking, when stocks normally are down the way they are this year, usually your bonds are holding up, and it's helped protect you against taking. So when the market drops, for instance, 15%, you expect bonds to be up a couple of percent, and so that your net is that you're not taking as big a hit on your money. If you have a 50-50 portfolio, or maybe 60-40, 60% stocks, 40% bonds, see, the bond part is going to hold up, and so that your overall, when the market drops, for instance, let's say 20%, as I mentioned, maybe you're only down 10 or 12% because the bonds are offering you that protection. Not this year. This year, the bond market's down minus 15 as well, so now you've got stocks down 15, bonds down 15, you're down 15 at least, and maybe more if you're not doing as well as, say, the S&P. And keeping in mind, 90% of funds out there do not do as well as the S&P. In fact, I've seen research showing even as much as 95% of mutual funds underperform the S&P 500 index. So something, again, to consider, and understanding how all these work and putting these tools to work for you. If you had fixed index annuity in place of much of your bonds, for instance, this year, when the bond market's down down 15, you wouldn't have lost 15% of your portfolio or of your bond portfolio in addition to stocks. You'd have been protected, which is what we want. So again, principal protection in a down market with opportunity for growth, more growth potential than a traditional fixed annuity, less risk and less potential return than a variable annuity. And I've seen these do, many of these, by the way, I've seen fixed index annuities, that is, I've seen them do as well as variables. But you do want to compare, and again, keeping in mind, if I'm looking at variable annuity, and this is where I don't think of it in the same way, a variable annuity, again, has those sub-accounts, so it's much like mutual funds. So I don't, even though they're comparing it here and saying less potential return, that's like saying less potential return than stocks. So in that variable annuity, assuming that it's invested in stock mutual funds and maybe some bond mutual funds, as to what that performance is going to be, and keeping in mind with those heavy fees, 3 to 5% a year, that's going to reduce my net return as well. So fixed index annuities, again, I would look at being more equal in terms of returns, but with a lot less risk. Returns are based on the changes in a securities index, and again, this we talked about like the S&P or the Dow Jones, but there are new ones like the what's it called? I'm sorry, the Citibank's Grandmaster. Wisdom Tree is another really good one. Barclay, I think it is. It has the Schiller Cape, which is another really good index that has done phenomenally well over the last 10 years. Actually 15 years, come to think of it. So there's some other options available to you out there that can be real beneficial, and it's worth exploring and researching those. So if you want a chance for upside gains in a good market with protection from downturns, fixed index annuity may be a good fit for you. And you can do a 1035 exchange, meaning you can move from one index annuity or one annuity. So if you've already got some annuities, maybe a fixed one, maybe a variable annuity, you can do what's a 1035 exchange for Internal Revenue Code 1035, which allows you a tax-free exchange, meaning I can swap one annuity for another annuity and have no tax consequences or implications even. So what are the benefits? Again, tax deferral, principal protection, lifetime income, investment flexibility, earnings credited. Here we see different type of resets, if you will, where you can have, whether that's every year, every 2 years, every 3 years, gives you an opportunity to readjust as far as your indices go within the annuity, to where you can change your allocations, if you will, to where you lock in gains. And again, depending on the product, that could be locking in every year, or more commonly, the one I use mostly, about every 2 years, you're locking in your gains. And then, so think of it this way. Imagine it goes up 10%, you lock in that gain of 10% into the principal. Now it can never go below that. So it's now not just so if, let's say, you put $250,000 in an annuity, okay, and it goes up 10% or $25,000. So and let's say it's a 1-year reset. So after 1 year, you get $25,000 added in. Now you're at $275,000, and that becomes your minimum guarantee. Or think of it even on a 2-year reset. Okay, it's the same thing. So let's say over 2 years, it did 10% total, 5% a year, right? Very nice return. And now that gets locked in, and now that becomes my new minimum guarantee in that contract. I can never go below that. Okay, so this is what we want to look at, is ways that we can protect our principal at the same time and locking in those gains. That's really a really nice benefit. So you lock that in, let's say, on that 2-year period, and then the next 2 years, maybe we have a period like this where the market goes down, maybe for 2 years. And now your original investment, if you had it just straight in the market, is going to be reduced as well. Here, you would not. Not only do you hold on to your original $250,000 principal, but you hold on to that gain as well. So now you can never go below $275 in my example. All right, earnings credited, again, every year, 2 years, 3 years, depending on the product. Beneficiary protection, we're not worrying about penalties, at least for a death benefit, because if you died before the end of the term, penalties are waived, and your beneficiaries would receive the full amount that you invested, including the earnings over the time it was invested. Spousal opportunities, this is one of the things too. Let's say you pass, your spouse would have the opportunity of continuing the contract in their name if it would be most beneficial, or they could cash it out and reinvest somewhere else depending on what their needs would be. So it gives you a lot of flexibility there. So if you're looking for and some things to consider, by the way, gains can be limited, and this is one of those areas of watching the type of annuity. Some of these have caps or participation rates, different things that are going to control maybe or limit how much earnings you can get. Ideally, we want high participation rates, and we do not want caps, and I'll explain both of those in more detail. And of course, fees. Some index annuities have fees, or you can elect for a fee to get a higher participation rate or to get different riders that may be of value to you. But all of these are things that we want to be thinking about. And you see the little friendly fact there. The S&P 500 has over 9.9 trillion benchmarked to the index, with index assets comprising approximately 3.4 trillion of this total. And the S&P is one common index that we do see in these fixed index annuities. All right, now here's what we're talking about with caps. A cap is saying that the most I can get is, say, 5%. So if in this example, if the index goes up 8, you're limited to 5. You're not going to get the full participation in that index. Now, having said that, there are indexes out there that you can get 100% or even above 100% participation. So we want to avoid caps, all right? If you think about it, if I got a 5% cap and 0 is the worst, that means I'm probably going to average 2 to 3%. And at that point, I might as well just have a fixed annuity giving me a guarantee. I'll get into that and more, but first a break. Join us here. We'll be right back on the Retirement Report.